The chapter also delves into the emotional dynamics experienced by investors. Lynch identifies three common emotions: concern, complacency, and capitulation. Concern often hinders investors from purchasing good stocks due to fears of market downturns. Complacency arises when investors become satisfied or content with their holdings, sometimes leading to a lack of vigilance. Finally, when stocks decline below their purchase price, investors may experience capitulation, leading to the sale of their stocks. Lynch cautions against such reactive behavior and highlights the importance of maintaining a long-term perspective. In conclusion, Lynch emphasizes the significance of the mirror test and conscious decision-making when it comes to investing in stocks. By considering personal circumstances, financial needs, and essential qualities, individuals can align their investments with their goals and risk tolerance. Furthermore, by understanding and managing emotions, investors can avoid impulsive actions that may undermine their long-term success. Don't ask if this is a good market, avoiding predictions and embracing the cocktail theory. Main idea. Peter Lynch emphasizes the futility of predicting the stock market based on past experiences and highlights the need to avoid making predictions altogether. He introduces the intriguing concept of the cocktail theory as a means to understand and navigate market scenarios. Lynch acknowledges the common question people often pose regarding the state of the market and when prices will rise. He unequivocally states that attempting to predict the stock market is a futile endeavor, as nobody truly knows what the future holds. Patterns from the past may not necessarily repeat, and humans tend to make the fallacious assumption that history will precisely guide the future. To illustrate this point, Lynch shares an intriguing anecdote from Mayan mythology. The Mayans, faced with the destruction of the universe, repeatedly prepared for the previous threat, only to encounter a new form of destruction each time. This story serves as a reminder that what happened before may not always recur, making predictions unreliable and ineffective. Even seasoned professionals struggle to predict the market accurately, so the question arises, how can amateurs be expected to do so? This is where the cocktail theory comes into play. Lynch introduces the analogy of a cocktail party where guests from various professions engage in conversation. The first stage of the market is marked by minimal interaction with the mutual fund manager, with guests primarily conversing about unrelated topics such as dental issues. This stage typically indicates an upward movement in the market. In the second stage, guests engage with the mutual fund manager for a short period but quickly return to discussing dental matters. This stage suggests a potential market rise of around 15%. The third stage sees everyone flocking to the mutual fund manager, seeking advice on which stocks to buy. Even the dentist seeks stock recommendations. During this stage, the market is expected to experience a significant rise of approximately 30%. Lastly, in the fourth stage, the crowd surrounding the mutual fund manager becomes overwhelming, with individuals providing him with stock tips. This excessive attention signifies a market peak, with a subsequent decline likely to follow. Through the cocktail theory, Lynch illustrates the dynamics of market behavior based on social interactions, emphasizing the inherent unpredictability and the danger of attempting to time the market based on such observations. In conclusion, Lynch advises against making predictions and attempting to determine whether it is a good market or not. Instead, he encourages investors to focus on long-term strategies, thorough research, and a disciplined approach to stock selection, rather than relying on unreliable predictions based on past experiences. Stalking the 10-bagger and I've got it, what is it? Main idea. In this chapter, Peter Lynch introduces the 6 categories of companies that investors should consider when deciding where to invest their money. These categories include slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Lynch emphasizes the importance of conducting research and understanding the company's market position, sales, and potential for growth before making investment decisions. Story. Lynch encourages investors to look closely at their surroundings, such as their homes, workplaces, or local shopping malls, to identify potential investment opportunities. He asserts that one does not need to be an expert or a CEO to recognize a prospering company. Individuals from various backgrounds, including workers, geologists, school teachers, or drillers, can identify promising prospects by leveraging their knowledge and familiarity with certain products or industries. This familiarity provides an advantage as consumers have clearer insights into a company's market position. However, Lynch warns that simply noticing a stock is not sufficient grounds for investment. It is crucial to conduct thorough research, akin to looking at one's cards in a game of stud poker. He emphasizes that people often put more effort into buying groceries than buying stocks, highlighting the need for a change in mindset. Lynch emphasizes the importance of understanding the impact of a product's success on the company's overall profits. Using the example of Pampers and Procter & Gamble, he cautions that a product's popularity does not necessarily guarantee significant profits for the company as a whole. Thus, investors should investigate the potential effect of a successful product on the company before making investment decisions. The size of the company also plays a role. Lynch notes that the biggest profits often arise from small companies rather than large ones, which have already reached their peak. Lynch then introduces the 6 categories of companies: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Slow growers are aging companies that have reached their maximum growth potential. Stalwarts are companies that fall between slow growers and fast growers, and investing in the right stalwart company can lead to significant profits. Fast growers have the potential to yield high profit percentages, often achieving market dominance in a specific domain. Cyclical companies' profits and losses are regular or predictable, influenced by external factors such as raw materials or government policies. Turnarounds are companies that have experienced setbacks and lack growth, presenting a riskier investment option. Asset plays are potentially rewarding investments that are often overlooked by larger investors, requiring investors to recognize their potential. Lynch emphasizes that companies can change categories over time, and investors must categorize a company within these 6 categories after conducting thorough research. In conclusion, this chapter guides investors in identifying the right investment opportunities by categorizing companies and conducting diligent research. By understanding the characteristics and potential of different types of companies, investors can make informed investment decisions. The perfect stock, what a deal! And stocks I'd avoid. Main idea. In this chapter, Peter Lynch discusses the types of stocks that investors should consider investing in and the ones they should avoid. He emphasizes the importance of understanding how companies plan to increase their earnings and highlights 5 strategies that companies often adopt. Additionally, Lynch advises investors to look for stocks with dull names and low growth, as well as companies that produce essential goods and have a significant share in their stocks. On the other hand, he warns against investing in stocks that are the talk of the town, companies promoted as the next big thing, and those with fancy names. Story. After categorizing the companies to invest in, the next step is to complete the story by examining how these companies plan to increase their earnings. Lynch introduces 5 strategies that companies commonly use to achieve this goal. These strategies include reducing costs, raising prices, expanding into new markets, selling more in existing markets, and revitalizing or closing underperforming operations. Understanding how a company plans to increase its earnings provides crucial insights for investors. Lynch suggests that stocks with dull names are more likely to go up. He gives the example of a company named Bob Evans Farms, which may not attract much investor interest.